Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 23rd of March. I'm Daniel Lam, your host for the podcast. Finally, after 24 years and two very close attempts when I was effectively pipped by the equivalence of goal differences, I won once more the Hong Kong Chess Championship for Standard Time Control, or slow chess as the layman would call it. This is my 12th Hong Kong champion title, counting across all the three time controls. So that was my historic moment. And I was looking for a historic moment at the FOMC. After one of the steepest rate hikes in Fed history, are we in for a Fed pivot this year? The answer was a no. So the Fed hiked rates by 25 bips. They modified the policy statement, signaling that the Fed's tightening cycle is close to its peak. Now, specifically, the committee anticipates that some additional policy firming may be appropriate. From the economic forecast of the meeting participants, it appears that another 25 bips hike is likely in May, followed by a pause. However, rate cuts or pivot is unlikely this year without a significantly higher unemployment rate. In fact, Powell drew clear distinctions between the Fed's interest rate policy and the new lending facilities that were set up to deal with bank liquidity. On interest rate policies, Powell said that he views a tightening of bank lending standards as a drag on economic growth equivalent to some uncertain number of rate hikes. In other words, the Fed will not cut rates to deal with bank liquidity issues. Rather, it will consider what tighter bank credit means for the overall economic outlook and let that guide its interest rate policies. Equities reacted negatively to the FOMC, with S&P 500 index closing at its day low. As the pivot may not happen this year, investors may be concerned about growth slowdown, leading to a drop in the US 10-year yield. Interestingly, US dollar fell, which could be a reflection of relatively stronger growth prospects in the rest of the world. Thus, in the US, investors should continue to look at higher quality bonds, as we see resistance in US 10-year yield at the 3.7% level. Elsewhere, in terms of equities, they may consider slowly accumulating on Chinese equities. For example, the Hang Seng Index, despite breaching the 19,300 support level earlier this week, it did hold up well around the 19,000 level, and that's despite the concerns on US and European financials. The consumption story is still intact in China, and we favor communication services and consumer discretionary. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.